Welcome from me, Guy Monson, to our latest 6-minute strategy filmed from our new offices at 50 George Street. Last year brought a series of geopolitical shocks, many stemming directly or indirectly from the Trump White House. Markets absorbed them in 2025. The question is, will they be as relaxed in 2026? The year has certainly started turbulently. US tariff policy is now in disarray after the Supreme Court struck down much of the President's legal justification. As alternatives are hurriedly assembled, the likely outcome is lower revenues, policy confusion, and rising uncertainty. At the same time, US naval forces are moving towards the Gulf, increasing the risk of conflict with Iran. This, of course, is global fragmentation in action, a world of intensifying great power rivalry, steadily replacing the post-war rules-based order. Yet alongside geopolitical tension, we're seeing some extraordinary capital deployment. The 5 largest AI hyperscalers are set to spend an extraordinary $650 billion on data centers in 2026 alone. That's roughly 2/3 the size of the US annual military budget. In the slide ahead, we will consider what this combination of hard power and heavy capital spending means for global growth and for your portfolios in 2026. So let's begin by looking at the left-hand panel and seeing how global growth is performing as we enter 2026. US in nominal terms, that's before inflation, what we feel in our pay packets, growing by more than 5.5%. UK, interesting number 2, growing at 4.2%, and Japan and Europe in the 3s. Those are perfectly decent numbers. Now, the central bankers seem to allow them to run a little bit hot, because ideally they want to squeeze a little bit harder on inflation. But as you see, the numbers for the US at 2.4% and for the rest of the world at 2.1% are not too far away from target. So I think central bankers will bear it, and this will generally be an administration, particularly under President Trump, that likes an economy, as I say, running hot. What's this mean about government finances? Well, I'm afraid they're still shocking. The IMF produced its latest 5-year projections out to 2030, and you can see the sort of trends are pretty well universally gloomy. US and China there in the left panel projected to run deficits of more than 7%. Now that China number is probably questionable, but it shows that they too, as well as just the US, have a debt problem. Interestingly, if the Chancellor Reeves sits to her targets, then actually the UK deficit comes out at around about 2.2%. We'll see where we go. What does this mean for the total debt pile? Well, in Japan it's coming down because they've run the economy hot. They run negative interest rates. This, if you like, has burnt off some debt. The new PM, with her supermajority in Japanese parliament, I think will push this further. She'll be very interventionist and push for growth and push for a higher inflation number that will eat into debt. The US picture looks grim, just upward and upward, up to 117% of GDP by 2030 and beyond. With China at 81%, which again is high for an emerging economy and probably a reason why they'll be reluctant to embark on very aggressive stimulus moving forward. Thirdly and finally, the world's got to contend with a vast capex plan from the AI hyperscalers. What I've shown here is a chart from Bloomberg showing the spending by 5 companies: Microsoft, Meta, Alphabet, Amazon, and Oracle. That $650 billion, as I said, is 2/3 of the annual US military budget. So you can see the scale that it's on. On the right-hand panel from the Bank of America Fund Manager Survey, this sort of spending is beginning to worry fund managers. You can see really that for the last 20 years, they've actually wanted companies to pay out less, to reinvest, have lower share buybacks, to give more capital for growth. Suddenly those numbers are reversed, and they're getting twitchy. The market also, as you will have seen, is looking now not just the winners from AI, but who might be the losers. So I think a rather more realistic assessment, but still another reason to expect robust growth. All of this is tying nicely into global earnings and dividends. This is our standard dashboard, which we looked at in many of these meetings. There's global equities forecast full year 2026 to grow around 16%. Monthly revisions are still upward. World dividend growth is robust and buybacks are strong. So the underlying platform is robust. Yes, there are risks. The geopolitical numbers are certainly dangerous, and of course valuations are high. So where does this leave us in the end? Well, we're in a regime of global fragmentation, from what we call deficient demand to security of supply, as regime change comes for the global economy. We're moving on indeed from that open cooperative arrangement to a competitive rivalrous one. The US will continue in this world to leverage its vast consumer market, its technology and its defence expertise to extract concessions from its partners. What does this mean? Increasing debt and deficits to unsustainable levels, higher and more volatile inflation, higher bond yields and term premia, but all of this supported in the equity market by AI diffusion, which is likely to push up productivity and deliver more robust profits, although of course there will be losers. Finally, that geopolitical risk are used for continuing to hold our golds, metals and real assets. So I hope that's helpful. I hope it shows the robustness of the equity market, but the new debate that's emerging as this fragmentation agenda begins to dominate investment markets across the globe. Thank you.